Very good afternoon, ma'am. We are live now. We can start with the session.
Thank you, ma'am. Good afternoon. Today, we will be discussing the chapter Forex Exposure and I have started.
Yes, ma'am. Can you go again?
So, let's get started.
Yes, we can start.
What is exchange rate? Exchange rate is the relative price of one currency in terms of another currency. Now, normally, when we buy a commodity, there is no confusion as to which is the one that is being sold and bought, and which is the one that is being used as a price. But when we get involved in Forex transactions, the problem starts because what is being bought or sold is also currency. What is being used to settle as a price, that is also a currency. That only causes the confusion. So what is an exchange rate? An exchange rate is the relative price of one currency in terms of another currency. Now, this quotation can be given as a direct quote or as an indirect quote. What do we mean by a direct quote? Now, let us say you want to buy something. What is it you want to buy? Notebook, pen, anything. Now, how will the price be quoted? Normally, how will the price be quoted? One notebook is equal to 50 rupees, isn't it? So, the commodity which you are buying and the shopkeeper is selling, that is 1 unit. The price you give is changing. For example, one notebook, 50 rupees, the price increases and it becomes 55. Notebook, one notebook, that is not changing. Only the price keeps changing. Now, this is a direct way in which we can understand, and therefore, this is called a direct quote. What is a direct quote? Under the direct quote, the domestic currency is the price, and the foreign currency is the base. Base meaning that is what we are buying or selling. The exchange rate is expressed as the price per unit of the foreign currency in terms of the home currency. In other words, the foreign currency is treated as if it is a commodity. Like any other commodity, 1 unit, what is the price will be stated. Foreign currency also is like a commodity. And therefore, supposing we are looking at dollars, 1 US dollar is equal to 84 rupees, means that is a direct quote. Then we also have what is known as an indirect quote. What is an indirect quote? Under the indirect quote, the domestic currency is the base currency and the foreign currency is the price currency. The exchange rate is expressed as so many units of foreign currency per unit of home currency. Therefore, this is also known as foreign currency quotation. So, what is the first thing we need to know? What is an exchange rate? What is an exchange rate? An exchange rate is the relative price of one currency in terms of another currency. So, which is the price? Which is the base? That we need to know. Under the direct quote, the domestic currency is the price currency or terms currency, and the foreign currency is the base currency. Therefore, under the direct quote, the exchange rate is expressed as the price per unit of the foreign currency That is, the foreign currency is treated as if it's a commodity in terms of the home currency. Therefore, this is known as home currency quotation. Under the indirect quote, the domestic currency is the base currency and the foreign currency is the price currency. The exchange rate is expressed as so many units of foreign currency per unit of home currency. This is also known as foreign currency quotation. This is one thing, direct quote, indirect quote. Now, there is also something called American terms, European terms. What is this American terms and European terms? Terms means another name for price. When we say, what are your terms? Meaning, what is your price? Similarly, American terms means USD is the price. What is the base? The other currency in the quotation is the base. Whenever we say, I am looking at a quotation, an exchange rate quotation, what does it mean? It means that two currencies will be there in that pair. So American terms means USD is the terms. USD is stated as the price. So the other currency in the quote will be the base. Then the next one we need to know is European terms. What do you mean by European terms? The base is USD. The price is the other currency in the quotation. Now, if you look at the professional forex market, it does not use the convention of direct quote, indirect quote. Why so? Because when you say direct quote, indirect quote, it depends on the location to determine the domestic versus foreign currency. Instead, the market uses quotes on defined conventional currency pairs. When both currencies are mentioned, the base currency is always mentioned first and the terms currency is mentioned next. So if I say USD INR, USD is the base, INR is the terms. If I say USD JPY, USD is the base, Japanese yen is the terms. If I say GBP USD, GBP is the base, USD is the terms. So the convention is that the base currency is mentioned first and terms currency is mentioned next. So the main exchange rates, if you look at, would be Euro USD, GBP USD, Australian dollars USD, New Zealand dollar USD, USD JPY, USD Canadian dollars, USD CHF. CHF is the code for Swiss franc. So now, from this, what did we understand? For quotes, there is a hierarchy of quoting convention. For quotes involving the euro versus base. For quotes involving the GBP, but not the euro, GBP serves as the base. For quotes involving the USD, but not the euro or GBP, USD serves as the base. These are the conventions, the hierarchy of quoting convention. What do we know? For quotes involving the euro serves as the base currency. For quotes involving the GBP, but not the euro, GBP serves as the base currency. For quotes involving the USD, but not euro or GBP, USD serves as the base currency. There is an exception to this. Australian dollar and New Zealand dollar alone serve as the base currency when quoted against USD. So when we looked at the main exchange rate, what is it I told you? Euro USD. Why? Because when euro is involved, it will be the base, USD will be the terms. When you give an exchange rate, both currencies are mentioned in the quote. The first currency is the base, the second one is the terms. That is why I told you Euro USD. When GBP is involved but not the Euro, GBP will be the base. Therefore, GBP USD. All other currencies, with the exception of Australian dollar and New Zealand dollar, USD will be the base. Therefore, Australian dollar, New Zealand dollar, still Australian dollar and New Zealand dollar will be the base, USD will be the terms. Then all other currencies, USD will be the base. And the other currency will be the terms. So this convention we need to know. Now, most major spot rates or exchange rates, if you see, it might be quoted up to 4 decimal places. There is one notable exception to this, that is Japanese yen. For Japanese yen, the exchange rates will be quoted up to 2 decimal places. Now, the reason for this is the units of yen per unit of other currencies is relatively large. Therefore, up to 2 decimals if you extend, that is enough. So these are the basic conventions for exchange rate. Hope you are clear with this. Then, when you are involved in forex transactions, you will be either buying it or you will be selling it. So we need to know about 2 rates known as bid rate, ask rate. What do you mean by a bid rate? Bid rate means buying rate. Whose buying rate? Because if you go to the bank, one of you will be buying and the bank will be selling, or you will be selling and the bank will be buying. So when we say bid rate, from whose perspective are we saying that it is a buying rate? It is the perspective of the bank. Therefore, bid rate is a rate at which the bank is willing to buy a currency. So this is the rate at which the customer can sell a currency. Next, ask rate. That is offer rate. From whose perspective? Again, from the bank's perspective. It is the rate at which the bank is willing to sell a currency. So this is the rate at which the customer can buy currency. So we need to know about bid rate and ask rate. Now, the title is Forex Exposure and Risk Management. So next we need to know about exposures. Basically, there are 3 types of exposures. Before that, what do we mean by a Forex exposure? What do we mean by a Forex exposure? A Forex exposure is a contract, projected, or contingent cash flow. Forex exposure is a contracted, projected, or contingent cash flow whose quantum is not certain at present. Why? Because it depends on the exchange rate prevailing at a future point of time. Now, Forex exposure, you can call it Forex exposure, foreign exchange exposure, currency exposure, refers to the potential impact that fluctuations in exchange rates can have on what? 3 things. 1, financial performance. 2, financial position. And 3, value. So, what is it I look at when I say Forex exposure? I'm looking at what is the potential impact. Why will there be an impact? Because of a fluctuation in the exchange rate. Where will I feel the impact? I will feel the impact in one of the three places. What is it? Or all of the three places. What is it? Financial performance, financial position, and value. Now, there are three types of exposures. What are they? They are transaction exposure, also known as trading exposure, translation exposure, also known as balance sheet exposure, economic or strategic exposure. Now, what do these exposures stand for? Transaction or trading exposure deals with changes in cash flows that result from existing contractual obligations. You already have some contractual obligation. What obligation you might have? Import payable, export receivable, interest payable on foreign currency loan, foreign currency repayment, foreign currency loan you have taken that you are repaying. So all of this, they are a result of existing contractual obligations. That when we have, that is known as transaction exposure or trading exposure. So where will I have or where will I feel the impact of this kind of exposure? I will feel the impact of this kind of exposure in my income statement. We already saw it could have an impact on your financial performance, on your financial position, or revenue. So now this will have an impact on your financial performance. It is the impact of past transactions on the income statement. Now, this is the result of, as we already saw, existing contractual obligations. Why am I having this impact? I'm having this impact because between the time I entered into a trade and the time I'm settling in it, the exchange rate, that is why I have this. So this is the first one. Next, translation exposure, also known as balance sheet exposure. Now, what sort of an exposure is this? Now, let us say an enterprise has assets and or liabilities denominated in foreign currency. And these have to be reported in the domestic currency, in the official currency. Then it becomes necessary for me to translate it into the reporting currency. This is translation exposure. The difference between this and transaction exposure is that actual conversion of currency does not take place when I talk about translation exposure. Whereas in transaction exposure, actual conversion of currencies takes place. So, translation exposure arises from the effect of exchange rate fluctuations on a company's balance sheet. Supposing a company has, let us say, foreign subsidiaries, then this will be there. Or when the company has assets and liabilities denominated in foreign currency, and these have to be reported in the reporting currency. So this is the impact of present assets and liabilities in the balance sheet. Then we have what is known as economic or strategic exposure. What is that? It refers to the impact of exchange rate fluctuations on the competitive position, cash flows, and overall value of the company. We said this exchange rate fluctuation can have an impact on the financial performance, which is your income measurement statement, financial position, which is your balance sheet, and value. So if there is an impact of the exchange rate fluctuation on the competitive position, cash flow, and overall value of a company. Why does it happen? It arises from changes in exchange rate that affects the pricing, demand, and competitiveness of a company's products or services. Now, whenever we did valuation the other day, we said the value of any asset is the present value of all future cash flows. So, a company is valued by the net present value of all future cash flows. Unexpected change in the exchange rate may bring about a change in the cash flows of the company. How? Directly by affecting its revenue and costs, and indirectly by affecting its competitiveness by the action of its competitors or the customers. Now we know price itself is made up of 3 C's. The price which I charge for my product or services is influenced by 3 C's: cost, competitor, and customer. So either it can be direct by affecting my revenue and cost, or it can be indirect by affecting my competitiveness. How I can have an indirect effect by affecting competitiveness? Supposing even though the exchange rate between my currency and the whoever is the customer, that currency, I could still have economic exposure when there is a change in the exchange rate, the competitors. Then it will affect my profitability, my market share, and my decision making. So it is the effect of exchange rate movements on the value of a business. The essence of economic exposure is that the exchange rate changes significantly alter the cost of the firm's inputs and the prices of its outputs, and thereby it influences its competitive position. And as a result, the net present value may differ from the one anticipated. So it is the impact on future cash flows and hence the present value of business. Is this clear? So this is the fundamental thing which we need to be clear before we get into anything else. Now, the first thing which we need to do is let's first have 2 small problems generally on exchange rate. We already discussed on the other day. Maybe have a couple of simple problems on that and then maybe move on to the others. Now, let us try these 2 problems. This is about investment, foreign investment, bond investment. What is the rate of return to an investor in US who invested in the security? During a year, the price of British bills, the face value is given, rose from 105 to 110 while paying a coupon rate of 8%. But because we're talking about a US investor and his investment in Britain, the investment has to be made in pounds. The exchange rate has a significance and the rate has moved from 1.8 to 1.7. You can try this. We already discussed the other day. For us, return means The return consists of two components, income and capital appreciation. Income will be closing price minus opening price. The income, whatever you are getting, the regular income interest plus closing price minus opening price, which is the capital appreciation. The only thing here is an exchange rate is involved because we are talking about investment in a foreign country. So what do we have? Price of the bond at the beginning is £105, but then since US investor has to invest in GBP, he has to buy it. So in terms of the domestic currency, dollars, how much is my investment? At the end of the year, I'll get the interest income, which will be in GBP. I will also get the price, which will again be in GBP. Convert both at the year-end price to dollars at the exchange rates given. See how much is the income, how much is the capital appreciation. The total will give you the return. Always return on investment, yield on investment should be expressed as a percentage. What do we get? Income plus capital appreciation. Always. Now this is over. We can move on to the next problem. Here we are talking about investment in bond, but a foreign investment. Income plus capital appreciation. Since it's a bond investment, interest is the income. Had it been equity investment, dividend would be the income. Closing minus opening price will be the capital appreciation. Now we can move on to the next problem. Calculate the rate of return. Always return would be % per annum. The price of a bond just before a year of maturity is 5,000. It's given in dollars. Its redemption value is 5,250 at the end of the period. So we know how much is the capital appreciation. Capital appreciation is always closing price minus opening price. Then interest is 350 per annum. So we know 250 capital appreciation plus 350, 600 is the return. 5,000 is the investment, 600 is the return. So straight away we can find the answer. But then the problem doesn't stop there. The problem continues. What does the problem say? The problem says the dollar appreciates by 2% during the period. So we need to look at from whose point of view we are doing this. Supposing it is from the point of view of the investor, US investor, then the investment is also in dollar, the return is also in dollar. We can find the return to be 12%, as we saw just now, 600 by 5,000. But then, if we are talking about a US investor, what is the need to mention regarding the appreciation? Is it necessary? If this is what I have to do, I'm talking about a US investor. Is there any need to mention the appreciation? No need. Therefore, maybe they are talking about US investor, isn't it? US investor means 12%. But because the appreciation or depreciation of the dollar is given, it means the appreciation or depreciation can be only relative to some other currency, which means some other currency is involved. Therefore, we have to look at it as from a non-US investor's point of view, what is the position? Now, how can we find? There are a couple of ways in which you can do. For a non-US investor, first we can say investment is 1. So with the 12% return, it became 1.12. But appreciation USD against the other currency is 2%. So another 1.02 of this. Receipts in the other currency would be 1.12 into 1.02, which is 1.1424. Investment is 1. 0.1424 is your return. So percentage return would be 14.24. This is one way of doing it. Where we do not have the other currency, and therefore we can simply, without mentioning anything about the other currency, we can find out what is the return. Only for a US investor, the return would have been 12%. But because the appreciation is mentioned, it cannot be just US dollar. There has to be some other currency. Which currency is that? We do not have an information, but we can find. Now, supposing there is a difficulty because the other currency is not there. You can take any currency. Obviously, we would prefer to take Indian rupees because that is USD INR is a very convenient and comfortable currency for us to understand. So what we can do, you can take USD INR. You can look at it as the investment being made by an Indian. Now what you can do, you can assume a spot rate. Any rate you want to assume, 80, 75, 85, anything. Then make the investment. You know 600 is the return. So totally 5,600 you will get. Dollar has appreciated 2%. Apply the appreciation. See how much is the investment receipt. Get the return in INR. Get it as a percentage. Now you will find it's the same thing. So whichever is more comfortable for you, you can do. Now we are not going to do both, either this or that. If this itself is comfortable, we could have stopped here. Otherwise, we could take any currency assume any rate and work it out. You'll get the same answer. Okay, now this is done. Now, what we need to see next is some exchange rate theories. What do you mean by an exchange rate theory? Intermediate, we would have done capital structure theories. So, exchange rate theories tell us what the exchange rate should be as per a particular theory. Now, you have many such theories. We are mainly interested in two theories. One is purchasing power parity theory. The other is interest rate parity theory. First, interest rate parity theory is what is most important. But of course, you will get problems with purchasing power parity theory also. But the most important one is interest rate parity theory. To do money market hedge, arbitrage, anything, we would require interest rate parity theory. So first we can discuss regarding purchasing power parity theory. Now this purchasing power parity theory is based on an economic theory which is known as law of one price. What does it state? The law of one price is an economic theory which states that the price of identical goods in different countries must be the same when the prices are expressed in the same currency. Of course, you will have a lot of assumptions. As with any economic theory, you will have a lot of assumptions that there is free market, there is lack of trade restrictions, there is price stability. So all this. Now, this forms the basis for purchasing power parity theory. Now, what does purchasing power parity theory tell you? If you have, for purchasing power, what is a related term for purchasing power? The related term for purchasing power is that inflation, isn't it? Inflation only leads to loss in purchasing power. So these two variables, exchange rate, macroeconomic variables, exchange rate and inflation rate are related in this theory. So using this theory, what can we do? We can find the expected spot rate. So you could have a direct quote or an indirect quote. If you have a direct quote, then S1 stands for expected spot rate is equal to S0, which is spot rate now, into 1 plus domestic inflation divided by 1 plus foreign inflation. On the other hand, if it's an indirect quote, S0 into 1 plus foreign inflation divided by 1 plus domestic inflation. Next, we need to look at interest rate parity theory. What is interest rate parity theory? Whatever you have as purchasing power parity theory in commodity market, the same thing, if you take to money market, that becomes interest rate parity theory. Now, using interest rate parity theory, what can you do? What can you do means you can find the theoretical forward rate or expected forward rate. So how do we go about doing it? Let us see how we find using interest rate parity theory. We can find the expected forward rate or theoretical forward rate. Using a theory, what we find can only be a theoretical forward rate. So forward rate is equal to spot into 1 plus RD divided by 1 plus RF if you are looking at direct quote. If you are looking at indirect quote, it will be RF in the numerator and RD in the denominator. Now, if you have noted down this, maybe we can do a problem in interest rate parity. So, do you expect the US dollar to be at a premium or at a discount in the Indian forward market? Now, wherever the interest rate is lower, that exchange rate will be at a premium. So, when you look at the interest rates, you find that India it is 8% and US it's 2%. So relatively US interest rate is less and therefore it will be at a premium. Using the formula, we can find what is the expected forward rate. So now we are looking at it from the Indian point of view. We know that it is a direct quote. Spot rate is 45.5 given. Annual interest rate, it's given as 8% in US, I mean in India and 2% in US. But we are looking at a 6 months forward rate. So we have to scale down the interest for 6 months and find the expected spot rate. I mean expected forward rate. Then the question is asking you, what is the rate of forward premium or discount? So forward minus spot divided by spot into 12 by 6 because we want annualized and what is given is for 6 months into 100 because we want it as a percentage. Okay. Now, we have looked at a few concepts. One, we saw what is an exchange rate. Then we discussed regarding direct quote, indirect quote, American terms, European terms. Then we looked at the hierarchy of exchange rate convention. Then generally for an investment, bond investment, how to find the return. And then we discussed two exchange rate theories, purchasing power parity theory and interest rate parity theory. Now, next we will discuss regarding arbitrage. This, what we are discussing regarding arbitrage, will also form the basis for our money market hedge, which we will be doing later. What do we know? Interest rate parity condition. What does it denote? It denotes a situation where interest rate differential is equal to exchange rate differential. It denotes a situation where interest rate differential is equal to exchange rate differential. Now, this condition does not always hold good. This is, after all, a theoretical rate. This is what is expected. Doesn't mean that it has to be in equilibrium. Therefore, interest rate differential may not be equal to exchange rate differential. Then this offers potential opportunities to earn profits. Now, interest rate arbitrage, a covered interest rate arbitrage, what does it involve? Name itself tells you. Covered interest rate arbitrage. Covered. So you will take a forward cover. So if you take a forward cover, what happens is the exchange rate risk can be hedged through a foreign currency forward contract. Then interest rate arbitrage you have to do. So the interest rate differential you try to exploit by borrowing in the cheaper currency and investing in the costlier currency. Now, arbitrageurs can make riskless profit. See, that is what they do, arbitrageurs. They always observe any difference in prices, then try to exploit it, try to use it. Now we will look at a problem on that. Is there any arbitrage opportunity? If yes, how can an Indian arbitrator take advantage of the situation? If he is willing to borrow, if he borrows here, it will be 40 lakhs. If he borrows in US, it will be 23,312. If you borrow in, see, we have seen that to take advantage, you have to borrow in one and invest in the other. So here, borrow in India and invest in US, or borrow in US and invest in India. These are the two situations we are contemplating. Put something like that, then we can discuss. There are two ways of doing it. One is a trial and error approach, where, as we have seen here, you can borrow in India, invest in US, or borrow in US, invest in India, see where you get a gain. Or another would be a refined approach, where even before doing this, we can decide where to borrow, where to invest. So you can try this. Try for a couple of minutes, then we can discuss the answer. So now, first let us discuss trial and error method. Then we can look at how to do it in a refined way. You can do either in the exam. Now, what does the question say? The question says, he can borrow 40 lakhs in India or 83,312 in US. So what we will do, when he borrows 40 lakhs in India, what happens? Borrow domestic, that is in India, borrow this. You need to convert it at spot rate. Now the spot rate is given 48.0123. Use that, see how much you can invest. Take the interest rate, interest amount. What is the receipt? What is the actual forward rate? So totally how much you will get. But you borrowed here, you have to pay interest. Do that. See what is the gain. Whatever receipts you have got converted in Indian currency minus whatever loan repayment you have made will be your arbitrage gain. Now here it is not a gain, it is a loss. Therefore, we should try the other. You are borrowing 40 lakhs, converting the domestic borrowings at spot rate. So how much you get? Invest that USD. What is the interest amount you'll get for 6 months? So totally what will be the deposit receipts? Apply the 6 months actual forward rate, get the foreign currency receipts, repay your domestic loan along with interest, compare foreign deposit receipts, how much you got, how much you repaid, whether there is a gain or loss. If there is a loss. Now, since this is not working out, we can look at the other one. What did they say? You borrow for an 83,312. How much interest you have to pay? So what will be the repayment in foreign currency? Convert your foreign borrowing into domestic currency. Invest here. Get the interest. What will be the domestic investment receipt? At actual forward rate, purchase how much ever is necessary to repay your foreign loan along with interest. The balance, the domestic investment receipts minus what you used for purchasing USD will be your arbitrage gain. Now, hope you have completed this. Now, this is a trial and error approach. That is, we borrowed in India, invested in US, and then found out what is the gain or loss. Then borrow in US, invest here, find what is the gain or loss. This is a trial and error approach. Borrow here, invest there, see what is the result. Borrow there, invest here, see what is the result. Alternatively, what we could have done is, first of all, I can find whether arbitrage is possible. How will I find that? I will find the theoretical forward rate, compare with the actual forward rate. If they are equal, arbitrage is not possible. If they are not equal, it means the equilibrium condition is not satisfied. Therefore, arbitrage is possible. This I will do. Then once I do that, first let us see how to do that. So in this, what I will do, I want to see whether arbitrage is possible. So what I will do, I will find the theoretical forward rate. Compare that with the actual forward rate. See whether they are equal. I know it is from the Indian point of view. I know it's a direct quote. Spot rate is given, forward rate is given. Interest rate we have. I know as per interest rate parity theory, I can find the 6 months forward rate as spot into 1 plus RD divided by 1 plus RF multiplied by 1 plus RD divided by 1 plus RF because it is direct quote. So I get 48.9356. This 48.9356 is different from 48.8190. Now, I will take a decision where to borrow, where to invest based on whether the actual forward rate is costlier or cheaper. If actual forward rate is costlier than theoretical forward rate, I will borrow domestic, invest. If actual forward rate is costlier than theoretical forward rate, I will borrow domestic, invest foreign. What is the logic? Actual forward rate is costlier. So foreign currency is costlier after the period. I could sell it. If I have to sell it, then I should have made investments in foreign currency now, which means only if I make investment in foreign currency now, the investment proceeds can be sold after the period. Therefore, I should borrow domestic. On the other hand, if actual forward rate is cheaper than theoretical forward rate, I will borrow foreign and invest domestic. What is the idea? Foreign currency is cheaper after the period. Should be bought. When you buy foreign currency, only if you have taken a loan and want to repay. That is the logic. So what is the position here? Actual forward rate and theoretical forward rate not equal, so arbitrage is possible. Actual forward rate 48.8190 is cheaper than theoretical forward rate 48.9356. Therefore, borrow foreign. Here we have come to the conclusion that you have to borrow foreign even without trying both. So straight away we can find out where we have to borrow and where we have to invest. That is the advantage. Is this method clear? This way also we could have solved. Instead of doing trial and error, we can use the concept and then we can do. Now, as I was mentioning the other day, that is yesterday, when we were discussing derivatives, I told you that forwards we will see when we do forex. So this is forex exposure and risk management. So we learned about exposure. We saw how using arbitrage we can gain. And before that, of course, we discussed two exchange rate theories, purchasing power parity theory and interest rate parity theory. Now, let us look at foreign currency forward contract. What is a foreign currency forward contract? See, when we are trying to exchange our domestic currency for a foreign currency, the transaction can be entered into on a particular day and settlement can also happen on the same day. Then it is known as cash or ready delivery. Supposing the transaction is entered into today and then the settlement is made after one day. That is known as value next day or TOM. Now, supposing the transaction is entered into today and settlement happens within 2 days, then it is known as spot. Now, mostly we will have only spot transaction. Spot rate only will be given. That is what we will take. Spot does not mean immediate. Spot means within 2 days. That is what is known as spot. Then we have anything beyond 2 days is forward transaction. The forward rate for a currency may be same, costlier, or cheaper than its spot rate. Three possibilities are there. The forward rate can be costlier, can be cheaper, or can be the same. So when a currency is costlier in forward, it is at a premium. When a currency is cheaper in forward, it is at a discount. Direct quote means it will be at a premium when the forward rate is greater than spot rate. Indirect quote means when the spot rate is greater than forward rate. Similarly, when a currency is cheaper in forward, it is at a discount. In a direct quote, the forward rate is less than spot rate. And in an indirect quote, the spot rate is less than forward rate. So, forward rate quotation, if you look at, it can be expressed in 3 ways. One, the forward rate can be directly given. Spot rate, 84 rupees. Forward rate, that is I am talking about the currency pair USD INR. You can say spot rate is 84 and forward rate is 3 months forward rate is say 85.5, something like that. Forward rate can be directly given. This is one way of expressing the forward rate. Method 2, how you can do is the forward premium or discount can be expressed as annualized percentages of the difference between the spot and forward. The problem which we discussed, the one before this, we expressed it as an annualized premium, isn't it? So like that, it can be expressed. Thirdly, you could give what is known as swap point. The swap points, that is the difference between the spot rate and the forward rate, may be expressed in terms of swap points. Swap points or forward points or forward spread is the difference between the spot rate and forward rate in a currency pair. Swap points are the number of pip points. That is, what is the smallest change possible in an exchange rate is known as a pip point. So, the swap points are to be added or deducted with the spot rate to determine the forward rate. If it is at a discount, you have to deduct. If it is a premium, you have to add. Now, two cases we can have, premium or discount. How will we know it is at a premium means, if the swap points are given, say 10, 15, that is the first one is low, the next one is high. You know, the base currency is at a premium and therefore forward rate is equal to spot rate plus swap point. On the other hand, if swap points are high low, supposing 20 and 15, then we know that the base currency is at a discount and it has to be deducted. We know that bid rate means the rate at which the bank will buy, ask rate means the rate at which the bank will sell. Always bid rate should be less than the ask rate. That is why if it is low, high, we add, high, low, we deduct. If the swap points are low, high, it is an indication that the base currency is at a premium. If it is high, low, it indicates that the base currency is at a discount. Up to this, are you okay? So, using this concept of swap points, we can do one problem. You can try this problem. Please try, then we can discuss. See here, swap points are given. 35, 25. 35, 25 means what? High, low. So what should you do? Deduct. What does it mean? The base currency is at a discount. That is a mean. So you would have tried. Can you check up? So now let's move on. What should we do? Now, the requirement of the question is calculate which of the following methods would be cheaper to Gibraltar Limited. Pay in 3 months' time with interest at 10% and cover forward for 3 months. Settle now at current spot rate and pay interest of the order for 3 months. So they have imported 5,000 bottles at $20 each. As we have seen, they can actually pay immediately or in 3 months' time. If they pay immediately, of course, they are going to use the overdraft limit. So now, what do we do? What rate we have? Swap points are high-low. What is it we have already seen? If it is high-low, we need to deduct it because it means it's such a forward discount. So what is the invoice amount? What is the interest rate? What is the interest amount? So in 3 months' time, if you pay, what is the position? Is this over? So the amount payable will be 61,80,750 in this. Supposing you make immediate payment, then whatever you have taken now, you're overdrawn, you have to pay along with interest. Let us see what is the position. Is it more than this or less than this? So immediately if you settle, what happens? We have the spot rate, invoice amount we know, you will settle this much, but this much you would have taken overdrawn for 3 months, for which you have to pay an interest. The amount settled would be 62,66,925 as against 61,80,750. So which is it? Amount settled to bank in 3 months' time is 62,66,925. On the other hand, we already saw that amount payable in 3 months' time with forward cover We already did that working. That is 6180, 750. So paying in 3 months' time with forward cover is cheaper. This will be your decision. It is cheaper by 86,175. That is your answer. Is this clear? So you gain 86,175. You pay 86,175 less. Is this over? Next. I hope you have completed this. Then we can look at money market hedge. Now, when you look at transactions in foreign currency, we could be looking at a payable or we could be looking at a receivable. Let us say first, we are looking at a foreign currency receivable. So now you have a foreign currency receivable. Let us say you're an exporter. You expect the foreign currency to depreciate. What you will do? You expect the foreign currency to depreciate, therefore you will borrow foreign and invest domestic. You have a foreign currency receivable. You expect the foreign currency to depreciate. So you would like to have the foreign currency now itself because it's more valuable now. But your customer is not going to pay you now. So what you will do, you will take a foreign currency loan and then you will convert it into domestic currency now and use it. Then what happens to the foreign currency loan means you have the original foreign currency receipt, isn't it? That will be used for that. Is this clear? On the other hand, if you are an importer and you expect the foreign currency to appreciate, then what you will do? If it appreciates and then you pay, you will be paying much more. You don't want that. You want to pay immediately because it is cheaper now. But do you have the money to pay immediately? You don't have. So what you will do? You will take a domestic loan and buy the foreign currency and pay it. The domestic loan which you have taken now, you have to pay along with interest. This is the idea in money market hedge. So, would you like to try this? What should the exporter do? An Indian exporting firm, Rohit Brothers, would like to cover itself against a likely depreciation of pound sterling. Following data is given. How much is your receivable? What is the spot rate? What is the payment date? What is the 3 months interest rate? Would like to cover itself against a likely depreciation of pound sterling. We're talking about an Indian exporter. You're talking about a foreign currency receivable. The exporter expects the foreign currency to depreciate. Therefore, he would like to have the foreign currency now itself. So how will you get the foreign currency now? If you take a foreign currency loan, that receipt will come. So you can convert it today itself. Then the loan you have taken now, what you will do? You will settle it using the original foreign currency receivable. This is the idea. Please try. So you can try, then we can discuss. So shall we see how it is to be done? Have you done? Shall we check the answer? Now, what is the position? We are looking at it from the Indian point of view. It is a direct good. I have a foreign currency receivable. I expect it to depreciate. There is a foreign currency asset, therefore create a foreign currency liability. I said we have to take a foreign currency loan. So foreign currency receivable, how much? So this has to be used to settle your foreign currency loan plus interest. So what is the foreign currency lending rate? That is for 1 year, therefore for 3 months, which is the period under consideration, how much? So how much loan you will have to take? Use the spot exchange rate, get the money, deposit it here for 3 months. What is the interest amount? What is the rupee receivable? Alternatively, what we could have done is we could have taken the theoretical forward rate, multiplied the foreign currency receivable. That will give you the receivables using theoretical forward rate. Now this you can use only for verification. Better if you get a problem, do like this. Or if you get an MCQ, you can try this. But if you get a descriptive question, full length question, for 5 marks, 8 marks and all, solve like this. But MCQ, they ask you how much it will be, means you can use this. Because when we use this theory, what are we assuming? It is in equilibrium. Therefore, what I will get by borrowing and investing is what I would have got with the theoretical forward rate. This way you could have done. Now this is the case of an export receivable, foreign currency receivable. Next we can look at this. This is the question of foreign currency payable when a company has imported. Litmus Industries has imported chemicals from UK and an amount of 1 lakh or 100,000 pounds is payable after 3 months. Following information has been obtained. Exchange rate is there. Annual interest rate is there. The previous problem, if you see, we had only one rate. We did not have the bid rate ask rate. Similarly, interest rate also we had only one. We did not have the lending rate and deposit rate. Now this has all that. And you have to consider forward rate, money market, and also whether you can just take a loan in India and avail a cash discount. All three you explore and see which is better. Please try. So all three you assess and then tell which is better. Okay. Now, first forward market. The CFO is considering forward market, money market, settle the payable by taking a loan in India and availing cash discount. An amount of 100,000 pounds is payable in 3 months' time. If you go for a forward, again, the question of swap points. What is it? High, low, which means the base is at a discount. So you have to deduct it. So deduct the swap points, get the forward rate. It's a question of import payables. So you need to buy, which means the bank needs to sell. Therefore, what rate is applicable? Ask rate is applicable. So forwards, this is the position. If I take a forward, I end up paying 73 lakh 5,000. Next, we are looking at money market. Money market head, what I should do? I have a payable, foreign currency payable, which I have a foreign currency liability. Therefore, I have to create a foreign currency asset, which means I have to deposit in foreign currency, which means I have to borrow in domestic currency. So is this the position? It's Indian point of view, direct quote, foreign currency payable. I want to go for money market head. As I told you, there is a foreign currency liability. Therefore, I have to create a foreign currency asset. I should borrow in India and invest in UK. So how much is the import payable? I invest in UK. Therefore, I'll get the deposit interest rate. And how much will be the rate? So how much I should invest now in order to get 100,000 pounds? I should find the, now I have to deposit in UK. So I have to take a loan. How much will be the loan? Because this loan has to be converted into pounds and then invested. What is the lending rate? For 3 months, how much is the interest? Therefore, what is the repayment? The idea is, if you have a foreign currency payable, there is a foreign currency liability. Therefore, you have to create a foreign currency asset so that you can meet that liability. If you want a foreign currency asset, you should be depositing in foreign currency. If you have to deposit in foreign currency, you don't have the money. You have to take a loan. So the original foreign currency loan will be met with the foreign currency deposit receipts, whereas you have to settle the domestic loan which you have taken. That is the idea. Alternatively, what can you do? You can make the payment immediately by taking a loan. You are also entitled to a discount for that. So is this better? All three you have to consider and decide whether it is good. So we have seen for a foreign currency receivable what we should do. We have also seen for a foreign currency payable what we should do. If it's a payable, we would like to choose whichever is the least. If it's a receivable, we would like to choose whichever is the highest. Now, what do we see? Forward is 73.05. This is 73.94. Discount is 73.12. So we will go with this being a payable. We will go with 73.05. So you will go with a forward. Is this clear? So our decision is to go for a forward. What do we know now? We are looking at money market hedge. We have discussed forward hedge. We have discussed money market hedge. What do we know about a money market hedge? If you have a foreign currency receivable, that is a foreign currency asset. You have to create a foreign currency liability, which means you will take a foreign currency loan. This foreign currency loan which you have taken, you will convert it and deposit here and get the investment receipt after the period. The foreign currency loan which you have taken will be settled by the original foreign currency receivable. You will take a loan in such a manner that the receivable will satisfy the loan amount as well as the interest. This is the position if you have a receivable. If you have a payable, what is the position? You have a foreign currency payable means you have a liability. If you have a foreign currency liability, create a foreign currency asset. How can you create a foreign currency asset? By depositing in the foreign currency. If you want to make a foreign currency deposit, do you have the money? No. So what you will do? You will take a domestic loan and deposit it there. Then what should you do? The foreign deposit which you are making along with interest should be sufficient to pay the original foreign payable. And the loan, domestic loan which you have taken, that along with interest, you will settle here. That will be your commitment. This is the idea when we use money market hedge. So forward money market hedge, whatever we have discussed till now, is that clear? Yes. We can have a short break and then move on to foreign currency options. We will discuss foreign currency options after the break. Hello, are you back? Shall we continue? So today we are discussing the chapter Forex exposure and risk management, your chapter 10. In this, first we discussed what we mean by an exchange rate, then direct quote, indirect quote, and then we discussed American terms, European terms. Then we discussed a couple of exchange rate theories, interest rate parity theory, purchasing power parity theory. Then covered interest arbitrage that we discussed. And then hedging techniques. Forward, money market hedge. Next, we are going to see options. Now, forwards, we know it can be expressed in one of the three ways. The forward rate can be directly given, or the forward rate can be expressed as what is the percentage premium or a percentage discount, or swap points can be given. If swap points are given, we need to look at whether it is at a premium or a discount. If the swap points are low, high, it means that the base currency is at a premium. If the swap points are high, low, it means the base currency is at a discount. So that much we have done. And yesterday we discussed about derivatives, where we saw what is a forward, what is a future, what is an option, and all that. Now we will see a problem where we have options. With that, foreign currency options, what we will do, that we will see. Okay. Now, let us see a problem in foreign currency options. What is the intrinsic value for the September 47.5 call option, for June 46 put option, break-even exchange rate? Yesterday also we discussed how to find break-even for a call, how to find break-even for a put. Which call option should be bought? And again, next, which option should be bought? Do you have any suggestions? Now let us look at the question. What does the question give me? The investment manager of a large software company receives the following quotes from its bank. Spot rate is given, 47.75 per US dollar. Then the US dollar option quotation is as under: call option, put option. The first column is about the various strike prices. For a future, you will have only one price. But for an option, you will have any number of options. And the premium for each of these will change. Yesterday, we discussed regarding option premium, how it is made up of intrinsic value, time value, and all that. So, for the strike price, what is the premium? As far as call option goes, what do we know? Call option, the intrinsic value, it is an option to buy. Therefore, if you are able to buy at a lower price, it is better. So E has to be less. So the lower the strike price, the higher will be the premium, because the intrinsic value is more. On the other hand, for a put option is an option to sell. Therefore, if we are able to sell at a higher price, it is better. Therefore, the premium for a put option will keep on increasing when you have the strike price to be more. That is what we observe here. This is for call June, September, and December. Similarly, put June, September, and December. And you will observe that for June, the premium is less as compared to September, which is less as compared to December. This is because as you have more time, time value will increase. That is the reason why it is like that. For the same strike price, if you look at June, it has the least. If you look at September, it is more. And if you look at December, it is even more. The reason being the time value, as far as the strike price 46 is concerned, the intrinsic value is the same, but time value is different. Therefore, we know the option premium is made up of two, the intrinsic value and the time value. So accordingly, you find the premium details given. Please solve these, then we can discuss. First, intrinsic value for call put, then break even for call and put. Do that, then we can continue. So what do we know now? Have you found the intrinsic value? So we discussed the moneyness of the option yesterday, where you have three things: in the money, at the money, and out of money. Intrinsic value means the amount by which the option is in the money. For a call option, it would be maximum of spot minus strike. For a put option, it will be maximum of strike minus spot. Strike rate, exercise, both are same. So for a 47.5 call option, what it is? For a 46 put option, what it is? So now that we have done this, what is the next one we are interested? Next, we are interested in the break even. What did we discuss regarding break even yesterday? For a call option, how will we find break even? For a call option, how do we find break even? Strike rate plus premium. For a put option, strike rate minus premium. That is how you'll find the break even. So that also you would have done. Okay, is that over? Now, what is the next requirement we have? The next requirement we have is that if the software company, no, fifth one, if the December spot rate is expected to be 48.5, which call option to be bought? Please try. Which call option will you buy? And the next sub question, if the software company receives its export income in December and its expected spot rate is 46.5, which option? Now, in the previous sub question, specifically they've asked which call option. Here they have not asked which, they have not mentioned what is the type of option, whether it is call or a put. What is it? You are receiving. Therefore, you would like to sell the foreign currency. Therefore, it has to be a put option. So now we need to look at, we are looking at the call option. We will see what is the payoff. We will consider the premium and see what is the gain or loss. Wherever you have the maximum gain, you choose. Alternatively, we can find the break even, and only if the spot rate is more than the break even, we can choose. Either way, we could have done. Next, which option is to be bought means we already saw it should be a put option. Now, you have not yet taken a decision. You have not yet taken a decision whether or not you want to buy an option. Therefore, supposing it results in a gain, we can decide we don't want it. So since there is no expected gain, we don't want to buy the option. Now, having completed this, let us look at the next sub-question. It is a discussion question. Do you have any suggestions? Now, what we need to look at is, they are asking you for intrinsic value of call and put. They are asking you for break-even exchange rate of call and put. So they are asking you regarding a decision as to which call option you will buy, which put option you will buy. And you find that they have foreign currency receivables as well as payables. So do you have any suggestion? Means instead of doing like this, can they do something else? Instead of an option, can they do something else? Now, here only we need to know regarding hedging techniques. Hedging techniques can be external hedging techniques or can be internal hedging techniques. What do we mean by external hedging techniques? External hedging techniques are undertaken especially for the purpose of hedging exchange rate risk. External hedging technique means specifically for the purpose of hedging exchange rate risk, you undertake some contract. In other words, it is not a part of day-to-day activities. Now, supposing there is only one type of exposure, receivables, payables, then companies may resort to external hedging techniques. What external hedging techniques you can have? Foreign currency forward contract, foreign currency option contract, foreign currency futures. These are all external hedging techniques. Now, as against this, you have what is known as internal hedging techniques. What do you mean by internal hedging techniques? Internal hedging techniques are techniques that are part of day-to-day operations of a company. Normally, whatever they do, it is a part of the day-to-day operations of a company. Then it is known as internal hedging techniques. It refers to a system where the forex exposure is managed as part of the normal course of business. It is managed in the normal course of business. That is, your transaction itself, do it in such a manner that you are able to hedge. That is internal hedging technique. Now, is internal hedging technique beneficial? Yes, it is beneficial. Why is it beneficial? Because external hedging techniques, you have to enter into it specifically for the purpose of hedging, and it involves cost also. On the other, even if you look at forward, there is no special cost in a forward like you have a premium for option. But still, what is it we know? Bid rate, ask rate. The bid ask spread is there, isn't it, for the bank? Now, if same currency, I buy, I sell, I lose out, isn't it? So it is beneficial for the company to have internal hedging techniques, because when we sell receivables, we will get a lower price. When we buy payables, we will pay a higher price. So we will lose out. If we have both receivables and payables, it makes sense for us to actually set off each other. Now, internal hedging techniques. What are all the various internal hedging techniques we have? Exposure netting is an internal hedging technique. What do you mean by exposure netting? Exposure netting involves creating exposures in the normal course of business that offset existing exposures. The process of adjustment of foreign currency receivable and payable at a given point of time is called netting. See, when we do netting, should we have the same currency? That is one point which we have to discuss. Should we have the same currency? It can be the same currency as the original exposure. Then you have to create an opposite exposure. Supposing I have a receivable, then I have to have a payable. You can create an opposite exposure in a currency pair that has a strong positive correlation with the currency pair of the original exposure. Like, for example, let us say you have Australian dollar, US dollar. This currency pair, you have original exposure. Then you can take New Zealand dollar and US dollar. There is a very high correlation. So even if it is not the same currency, you can do that. Similarly, Euro USD, GBP USD, high correlations. You can do that. High positive correlation. Then you can create an opposite exposure. You can also create a similar exposure in a currency pair that has strong negative correlation. What do I mean by strong negative correlation? That is, if one goes up, the other comes down. Then, even if it is a similar exposure, I will be able to achieve it. Now, this, if you see, is somewhat similar to the diversification which we are looking at in portfolio management. It works in the same manner. Then I can look at sourcing. What is sourcing? Supposing I export, and that, let us say, I invoice in USD. Then whenever I'm sourcing, that also I can make it as USD, so that the effect is again reduced. Or alternatively, what I can do, I can choose the currency of invoicing. I'm having all this problem only for foreign currencies involved. So maybe I can have the invoice in my domestic currency itself. Now this has a problem in that the other party may not agree to this. Because if you do it in your domestic currency, the other party is fully exposed to the risk. Then we can sort it out by risk sharing, where partly we do it in our currency and partly we can do it in the other currency. Or both parties may agree, I don't want your currency, you don't want my currency. Let us take a stable currency and do it. Now this exposure netting and all, there could be a timing difference. Therefore, leading and lagging has to be resorted to. What do you mean by leading? Leading means advancing. Lagging means postponing. So a company could lead payment in a currency that is likely to appreciate. Or it can refer to postponing a payment. When will you postpone a payment? You will lag payments in a currency that is likely to depreciate. Now, one problem with this is that you could have a price variation. As I told you, if you decide to have it in your own invoice, then the other party might factor in the price difference in that. So the essential answer to this question is internal hedging technique. Have you understood what is internal hedging technique? So now let us move on to the next question. So options we did. This is an OTC option. When we discussed options yesterday, you would remember that we had both OTC option as well as exchange traded option. We had both, you would remember. So this is an OTC option. Let us look at exchange traded options. You have to tell me whether this is OTC or exchange traded. Then we will discuss the difference. Kindly consider, think whether this is OTC or exchange traded. How to distinguish between an OTC option and an exchange traded option? Now, currency options, how should we approach? How should we approach a currency option? First of all, we have to identify whether it is an OTC option or an exchange traded option. When we discussed derivatives yesterday, we were discussing that forwards are always OTC, futures are always exchange traded, options can be OTC or can be exchange traded. This is what we discussed. Now, first thing we have to consider is whether the foreign currency exposure is a payable or a receivable. Then If it is a payable, I am interested in a call option. If it is a receivable, I am interested in a put option. Whichever option you buy, call option or put option, premium has to be paid upfront. And in the domestic currency, how much it is, that we have to see. Now, for a call option, all this we are discussing is OTC option. For a call option, domestic currency, you will pay on exercise of the option. Then option premium also you have paid, so you will add. For a put option, you will receive the domestic currency. Put option premium you would have paid. One is an inflow and the other is an outflow, so you will take the net. As far as OTC options are concerned, there is not much of a complication. Now, exchange traded option. How do I decide whether the option is OTC or exchange traded? Any exchange traded instrument, what do we know? We know that it will be standardized. Standardized regarding what? That we have to see. What is it standardized? First of all, what? What is the underlying currency? What is the underlying currency? Also known as contract currency, also known as base currency. What is it? Now, that contract currency and the contract size should be given. Then, the next one, as I told you, is the contract size. That is how much? What is the contract size? What is the lot size of the base currency? So, in an exchange traded option, since everything is standardized, we need to have the contract size. If that information is missing, we need to assume that whatever is the exposure, that is the contract size. Then, when is the expiration date? That has to be given. Again, that will be standardized. Then, what is the settlement? Is it cash or physical? That should be there. In an exchange traded option, in the absence of information, cash settlement is what will be assumed. So now we have seen 4 things. 1, if it is an exchange traded option, what is the underlying contract or base currency? That will be given. Exchange traded means it is standardized. We cannot change it. If they say that is the base currency, that is what we have to take. 2, lot size has to be given. If lot size is not given, what we will do? Whatever is our exposure, we will assume that is our lot size. Then expiration date should be given. If that is not given, what we will assume? Whenever we are making the settlement, that is the expiration date. Then cash or physical settlement. There what we will assume? That it is cash settled. So next what we should do? We should look at the underlying currency. That is the base currency, which means that is the currency that will be bought or sold. Then we should consider the terms currency. This is the currency which should be used for terms, for settlement. Then we will have to decide what we want to do, how much we have to receive, how much we have to pay, like that. Now let us go to this problem. Till this you're okay, isn't it? You're clear, isn't it? Now, what does the problem say? You're required to recommend cheaper hedging alternative for XYZ. We have discussed risk management yesterday. At that time itself, we saw risk management is bringing the risk to the acceptable level at the least possible cost. So always whenever we take a decision, we would like to get the best or the optimal decision. XYZ, an Indian firm, has to pay 500,000 Japanese yen on 30th June. So what do we know? We know that they have a payable. They have a foreign currency payable. We are looking at it from the point of view of the Indian company. They have a foreign currency payable. To hedge the risk involved in foreign currency transaction, the firm is considering two alternative methods. What are they? Forward market cover and currency option. On 1st April, quotation is given. What is the spot rate? What is the 3 months forward? They have given. Then the prices for foreign currency, forex currency option on purchase are as under. Now, strike price is given. Call option, what is the premium given? Put option, what is the premium given? Price is given in Japanese yen. Therefore, what is the base? The other currency, Indian rupee only, can be the base. Because you find that strike price is given in Japanese yen, premium amount is given in Japanese yen. So what is it we can conclude? We can conclude this is an exchange traded option. That is the reasonable conclusion we should arrive at. So now you can compute based on foreign currency forward, what is the position? For option, what is the position? And then between the two, which one you want, you can decide. Would you like to try? Please try. So now, first let us look at forward. If you look at the forward rate, how is the forward rate given? Japanese yen per INR, which means INR is the base. Therefore, it is an indirect quote. Is this clear? So what is it we know now? Now this is an area where some students might commit a mistake. If you look at an indirect quote, always we know the bid rate is cheaper than ask rate. In a direct quote, I mentioned this even when we were discussing the quotation. Always bid rate is cheaper than ask rate. In a direct quote, bid rate is also less than ask rate. Whereas in an indirect quote, bid rate is more than ask rate. So if I convert the indirect quote into a direct quote, that is from JPY per INR to INR per JPY, look at this, 0.5019 is less than 0.5069. How you convert one quote into another means inverse. You have to take the inverse. So we need to apply the correct rate in order to Is this clear? First, you can understand which rate to use by looking at whether it is, see, three different ways you can solve this. First, that it is an indirect quote, therefore my bid rate, if it is a direct quote, I know bid rate will be less than ask rate. If it's an indirect quote, it is the other way. Bid rate will be, always bid rate is cheaper. But when you compare the figures, bid rate will be greater than ask rate. You know this. You can solve straight away. You can take 1.9726. Then another way you can look at it is you can convert it into a direct quote and then see which is more, which is less. Always bid rate is cheaper than ask rate is costlier than bid rate. No confusion there. But in a direct quote, directly bid rate will be less than ask rate. But in an indirect quote, it will be the opposite. So either straight away, understanding that in an indirect quote, it will be like this, you can do. Alternatively, you can convert it into a direct quote and do. Or what you can do, you can apply the rates and check up where it is more, where it is less. Obviously, the bank will collect more money from you and accordingly decide. If you are through with this, we can move on to the next one. Next, we need to go to the option. We have already discussed, we checked out that when you look at the option, what do we see? The prices for Forex option on purchase are as under. Strike price is given in Japanese yen. Premium is given in Japanese yen, which means Japanese yen is the terms, which means INR is the base. So they are trading only in INR. What is it you want? You want to buy Japanese yen. You go to the exchange and tell them, I want to buy Japanese yen. They say, no, in this exchange, the base is only INR. We will only buy or sell Japanese yen. Now you think, anyway, what is it I want? I want an outflow of INR and an inflow of Japanese yen. They are anyway saying their terms is Japanese yen. So I can sell INR for which they will make the settlement in Japanese yen. So that way you will know. But you are selling INR, it is a put option, not a call option. So accordingly, you will see. It is a put option to sell INR. How do I come to that conclusion? Because I am doing it from the Indian point of view. Foreign currency payable is Japanese yen. For the currency option, base currency is INR. So it has to be a put option to sell INR. Foreign currency payable, put option strike price, what is the amount payable, what is the premium, how much premium I have to pay. Premium has to be settled upfront, so spot rate is applicable. So you would have worked it out. Between the two, which one do you want to choose? Is the question. Whichever outflow is less, you want to choose. Therefore, you want to choose currency option. So how did we identify that it is an exchange traded option? We already discussed exchange traded option means it will be standardized for 4 things. What are they? What? What is the underlying or base of contract currency? 2. How much? What is the contract or lot size? 3. When? When is the expiry date? 4. How will the settlement be made? Physical or cash? Is this done? Are you clear with this? So we have given our recommendation. So now, as I was telling you, how do we decide whether it is an exchange traded option or an OTC option? 4 things exchange traded options will specify. It is standardized for 4 things. What is the underlying or contract or base currency? 2. What is the contract or lot size? 3. When is the expiry date? 4. How is the settlement made? Are they just settling for the difference or the full thing is being given? Now in this, the most important is the base currency. So if it is an exchange traded option, the base currency will be given. In this problem, we saw the base currency is given. Even if the contract size is not given, that's not an issue because whatever is the exposure, we will assume that is a contract size. Now, the base currency is the currency that is being bought or sold. The terms currency is the currency that is being used to make settlement. That is the price. The analysis is from the Indian point of view. Indian, what does he want? He wants to buy Japanese yen. So, if it is an OTC option, Japanese yen should have been the base currency. Since we find that INR is the base currency, we have inferred that it is exchange traded option. Also, if you see the strike price is given as in Japanese yen, therefore that is a terms currency. So Indian rupee has to be the base currency. Also, premium and all is given in Japanese yen. Then the company wants an inflow of Japanese yen. They want an outflow of INR. So what they can do? Anyway, they are selling or buying only INR means you decide you will sell INR, matter over. So it is an exchange traded option. The problem says for the excess or balance of JPY covered, it indicates there is a contract size, but they have not given what is the contract size. So I'm assuming that the full exposure is the contract size. Are you clear with this? Shall we move on to the next question? Let us see what this problem is about. Give your recommendation. An American firm is under an obligation to pay interest of Canadian dollar 10 lakh 10,000 and 7 lakh 5,000 on 31st July and 30th September respectively. The firm is risk averse and its policy is to hedge the risk involved in all foreign currency transactions. The finance manager is thinking of hedging considering two methods, fixed forward or option contract. Now we know what is a forward. What is a fixed forward? Forwards can be of two types. It can be a fixed forward or an option forward. What do I mean by a fixed forward? A fixed forward contract is a forward contract where the date on which the settlement to be made is fixed. On the other hand, an option forward is within a period which they will mention, you can do it. As far as we are concerned, for working out the problem, whether it is fixed forward or option forward, it doesn't have any difference. Or option contract. Fixed forward is also a forward contract. Option forward is also a forward contract. So fixed forward or option contract. This is a proper option. It is now June 30th. So 31st July means 1 month. 30th September means July, August, September, 3 months. That's why they have given you 1 month forward rate and 3 months forward rate. Following quotations regarding rates of exchange, that is US dollar per Canadian dollar, from the firm's bank were obtained. So you have that. US dollar per Canadian dollar. Therefore, Canadian dollar is your base here. If you look at it, you are looking at it from the American point of view. If US dollar per Canadian dollar is given, US dollar is changing. Therefore, it is a direct code. We know that. Then for the option, what is the position that is given? We will come to option a little later. First, let us complete forward. What do you get? For forward, what do you get? It's US point of view, it's a direct quote because US dollar only is changing. For 1 Canadian dollar, what is the price is given? So it is a direct. So for foreign currency forward contract, what do we have? Do you have this? They have two commitments on 31st July and 30th September. From the US point of view, we have to do, it's a direct quote. Foreign currency payable is Canadian dollar. So next, we can move on to options. Now what do we see? The price here means the premium. For a Canadian dollar, US dollar option on a US stock exchange, contract size, see this is an exchange traded option. Why contract size is given? Payable on purchase of the option are as follows. For different strike prices, call option July, September, put option July, September, what is the premium that is given? According to the suggestion of finance manager, if options are to be used, 1 month option should be bought at a strike price of 95 cents. And for the remainder uncovered, the firm would bear the risk. For this, it would use forward rate as a best estimate of spot. Transaction costs are ignored. Give your recommendation. Now, one very important thing to note here is the strike price is given as US dollar, whereas the premium is given in terms of cents. That we should observe. The price, that is the price of the option, which is the premium, is cents per Canadian dollar. When the strike price is given in US dollar, the premium is given in cents. So that we should observe. This is $0.93, but this is not $1.56. It is 1.56 cents. Now, the problem says, according to the suggestion of finance manager, if options are to be used, 1 month option should be bought at a strike price of 95. What we will do when we are working, we will work out all three. There is a reason why I am telling, because I want to explain a particular point there. So we will do all three. We will not restrict only to 95 cents. We will do for $0.93 or 93 cents. We will do with strike price $0.94 or 94 cents and $0.95 or 95 cents. All three we will do. Please try. Have you done for 1 month? All the three? Can we check up? So now, what do we know? We are doing it from the US point of view. We are looking at a foreign currency payable. It is an exchange traded option because the base currency is Canadian dollar, which is the foreign currency. Since I have to pay, I have to buy a call option. Now 1 month forward rate, I know. How much is the interest payable for in 1 month's time, I know. Contract size I can find. Number of contracts has to be rounded down because what does the problem say? The problem says for the remainder uncovered, which means there is something uncovered. So for that, I have to round it down only. All the three I told you we will do, even though the problem is asking only for 95, we will do for 93 and 94 cents also. Or I have, if you take it in dollars, it will be 0.95 US dollar, 0.93 US dollar, and 0.94 US dollar. 100 cents make $1. What is the amount covered by the option contract? What is the amount payable? Premium is given in cents. Now I'm converting everything into dollars. So 0.65 would become 0.0065. So what is the option premium to be paid? So this is clear. So once this is done, there is an amount uncovered by the option contract. So what is the estimated forward rate for that? So that how much it translates to, what is the total amount, what is the outflow under fixed forward, what is the recommendation? Do you want to go for fixed forward or do you want to go for an option means? I want to go only for the fixed forward. Yes, system. Okay, now I told you there is a reason why I told we will do all three, even though the question requires you to do only one. The reason is this. See, I know that the balance, I'm going to use forward rate to be the expected spot rate. So there will not be any difference there. It is only for the amount which is covered by the option contract. As far as forward is concerned, it is 0.9301. As far as option is concerned, we know the effective price is whatever is the strike rate plus the premium. Now, I could have very easily come to the conclusion that I would be interested in this. Why? Because look at the call strike rate, 0.95. Over and above this, I'm going to have the premium. So clearly, forward is dominant because in addition to the strike price, I have to pay the premium for the option. Whereas forward, it is just the forward rate. Similarly, 0.94. So initially itself, I should be able to discard 0.95 and 0.94 and look only at 0.93 because 0.93 only the strike price is less than the forward rate. But considering the premium, if you say, it is more. So first round itself, I should have discarded 95 and 94. If anything, I should have considered only 93 cents, but including the premium, that also is higher. Therefore, forward is better. To highlight this point, I asked you to do all three. So even if they are considering the problems that the finance manager would consider 95, that doesn't make any sense, isn't it? Because 95 cents plus premium, where is the comparison? This is only 0.93. So this would be definitely better. Probably why in the question they have suggested 95 cents. That is where you have the least premium. But obviously, we already discussed that as the call price goes up, premium will be less. As the put price goes up, premium will be more. So that will be the case. Now coming to the next one, for 3 months, what is the position? But anyway, this you should not work out like this in the exam. Just comparing 0.9301 and the various strike prices, the effective call option rate, you can't do that because they would expect you, if they give you a full question, they would expect you to do the working. Similarly, come to 3 months, again, both strike prices we will see. Same story that it is US point of view, it's a direct quote, it's a foreign currency payable. Exchange traded option, base currency is Canadian dollar. So call option can be put. 3 months forward rate, what it is, what is the interest cost, what is the contract size, how many contracts. For the balance uncovered, you will use the forward rate as the best estimate of spot. Same story, you have the two things now, 0.93 and 0.95. See, as far as futures price are concerned, you will have only one future price. But as far as options are concerned, options will be available at many strike rates and the premium will change based on the strike rate we have. So what is our final conclusion? We have to consider the amount payable under the option. That is when you exercise the option. Anyway, 3 months option premium also we should pay, but the premium would be paid upfront. And what is uncovered by the option? We will use the forward rate as the best estimate of spot. So what is the total amount? Here again, we could have come to the conclusion looking at the effective call option rate. Here also, 3 months forward rate is 0.9356. So there is no point or purpose in even considering 95 cents because that is more than the 0.9356, and also you have to add the premium. Call rate plus premium will give us the effective call option rate. So have you done the next one also? Can you check the answer? Here also, as I told you, you could have found the effective call option rate, but then in the exam, if they give it as a descriptive question, you would be expected to work it out fully. So if you're through with this, we can move on to the next question. This effective call option rate comparison with the forward rate, coming to a decision, please do that only if it is given as an MCQ or for the purpose of verifying your answer. If they give you a 6 marks or 8 marks question, if you do like this, they will not give you the marks. Shall we move on to the next question? Shall I take it that you have completed this? Yes, please try this. You try this, then we can discuss. Contract size is given. Therefore, this is only an exchange traded option. You know that. The question requires you to consider 3 alternatives: forward cover, money market hedge, and currency option. Would you like to check up forward cover? Would you like to check up one by one? Forward cover first, then money market, then currency option. Now, if we look at the question, which of the alternatives is preferable for the company? The company is considering three alternatives: forward, money market hedge, and currency option. A Limited of UK has imported some chemicals worth 364,000 and then 897, 3,64,897 US dollar from one of the US suppliers. The amount is payable in 6 months' time. The relevant spot and forward rate given. Borrowing rate in UK and US given. That is given for the purpose of money market hedge. Deposit rate also given. Currency options are available under which one option contract is for GBP 12,500. So contract size is given. It is an exchange traded option. The option premium for GBP at a strike rate of 1.7 GBP is 0.037 for call option, 0.096 for put option for a 6-month period. Now we have to identify whether we want a call option or a put option. Before that, you need to do forward and money market. First of all, from whose point of view are we doing? UK point of view. Is it a payable or a receivable? It is a payable. Is it a direct quote or an indirect quote? It is an indirect quote. What do we know about indirect quote? Now we know that always bid rate is cheaper than ask rate. In a direct quote, bid rate will also be less than ask rate. In an indirect quote, bid rate will be more than ask rate. Now this is something which leads to some confusion in the minds of students. Now, we were discussing the best way to understand this is look at foreign currency as if it is a commodity. Let us say you want to go buy fruits. If the fruit seller tells you one fruit is equal to 25 rupees, very clearly we can understand. On the other hand, if the fruit seller says, for 100 rupees, I'll give 4 fruits. It's a different, indirect way of giving the price. You want the price means for 1 unit of what you are buying, what is the price? It is not for given number of rupees, how much you will get. So, that is how we need to look at whether it is a direct quote or an indirect quote. So, when I say one fruit is equal to 20 rupees, has become one fruit is equal to 25 rupees, I know clearly it has gone up. 25 is more than 20. This is a direct quote. On the other hand, when I was able to get 5 fruits per 100, now I am getting only 4 fruits per 100. It has become costlier, even though 4 is less than 5. That is why in a direct quote, bid rate is less than ask rate. In an indirect quote, bid rate is more than ask rate. Bid rate is always cheaper, but direct quote means it will be less. When you compare just the numbers, it will be less. Indirect quote means when you just compare the numbers, it will be. Is this over? Next, we are interested in money market. Money market, what should we do? Is it a foreign currency payable or receivable? It is a payable. So do you have a foreign currency liability? Yes. If you have a foreign currency liability, what should you do? Create a foreign currency asset. Borrow domestic and invest foreign. What is the amount of import payable? You want to invest in the foreign country. How much interest will you get? Therefore, how much should you invest now in order to get 3,64,897 along with the interest? It is enough if you invest less. We want to find the present value. Present value is always future value divided by 1 plus RF. Therefore, this is future value divided by 1 plus RF. If you want it clearer, future value divided by 1 plus RF. That is how we got this figure. So if you have to deposit 356,867, how much should you borrow? Because what you borrow, you will convert it at the spot rate. So consider the spot rate to decide. Then see what is the domestic borrowing rate, interest. So what is the repayment? Now we already have a forward. What is the amount? 236,102. For money market, 236,510. Then option we have to see. Is this done? Is it clear? So now let us move on to options. Options, what do we know? 12,500 GBP. That is the contract size. Now, unlike the earlier problem, where they are set for the balance uncovered, by which we know that we have to round it down, here nothing has been mentioned, which means you can decide whether you want to round it up or you want to round it down. I am talking about an exchange traded option. What is the base currency? GBP. What is the terms currency? USD. They require an inflow of USD and outflow of GBP. So make it as a put option to sell GBP and receive USD. Then there is a mismatch between what you want to sell and what they are accepting. Change your position. Finally, what do you want? Do you want an inflow or an outflow of which currency? Accordingly, you decide. So now we are rounding it up to 18. Then what is the total contract amount? What is the put option premium? What is the premium amount to be paid upfront? Upfront premium has to be paid. You can get it only with the spot rate. So what is the premium amount? On exercising the option, what is the amount you will receive? Out of which, how much ever import payable you have to pay, you will pay. Balance excess amount, you will convert. So what is the net outflow? Now, alternatively, we could have decided to round it down, but for that, of course, slight variation in answer will be there. You need to give your decision as to whether you want to round it up or round it down. No need to work out both in the exam. One of the two you can decide. Now, what do we find? Forward cover, what is the amount? Money market, what is the amount? Currency option, what is the amount? Currency option is the least. Since it's a payable, you would prefer to go for currency option. This would be a decision. So maybe, have you completed this? We can maybe try one more problem before we close today's session. So you can try this problem. This is on forward, or we discuss leading and lagging. Remember, this is about lagging the receivable. So internal hedging, the timings may not match. So how about leading or lagging to match the time? So you can try this. Now in this problem, what do we observe? Evaluate both the options if the cost of rupee funds is 12%. Which option is preferable? NP and company has imported goods for 700,000 US dollar. The amount is payable after 3 months. Company has also exported goods for 450,000 US dollars. This is receivable in 2 months. So you find that there is a mismatch in the time. Payable is after 3 months, whereas receivable is in 2 months. So you have already taken a forward contract for receivable. The market rates are given. Spot 48.570. What is this? 48.5 and 48.70 bid rate, ask rate. 2 months forward rate, 3 months forward rate. You find that it is low high. Therefore, the base currency is at a premium. You have to add. There are two options to cover payables in the forward market. This is the first option. So lag the receivables by 1 month and cover the risk only for the net amount. No interest for delaying the receivable is earned. Evaluate both the options. If the cost of rupee funds is 12%, you can please try this. So first we can look at the bid and the ask rates. As we already discussed, swap points are low high, which means the base currency is at a premium and therefore you would add. What are the options given? We have been given two options to cover payables in the forward market. Then what about receivables? That we have already done. And the rate also is given. So if that is the case, what is your net payable in 3 months? Export receivable in 2 months I have, for which I have already taken a forward contract. So what will be the export receivables after 2 months? In 3 months time, I can use this to make the payment partly. So in the meantime, for 1 month, I would have deposited how much amount I will get. In 3 months time, at the forward rate, what is my import payable? So what is my net payable? We have an export receivable in 2 months. Receivable. Therefore, we are selling, bank is buying, bid rate is applicable, for which contract already taken. So what is the amount you will get in INR? You need this money only in 3 months' time when you want to make the payable. So what is the interest you will get? What is the rupee value of receivables? In 3 months' time, how much payment you have to make, at what rate? So what is the import payable? For this import payable, already you have the receivables which you have deposited and got along with 1 month interest that you deduct. So what is the net payable? This is the first option. So once this is done, the other option which we have is to lag the receivable by 1 month and cover the risk only for the net amount. No interest for delaying the receivable is earned. But here, if I lag the receivable, I have already entered into a contract. That contract has to be cancelled. When you want to cancel a contract, you have to take the opposite position. Already in the contract, which I have taken, what is the contract I have taken? I have already contracted at the bid rate. So now, if you want to cancel, you will have to take the opposite position. Already, you have taken a contract to sell it to the bank. Now, today, what you should do, as if you are buying it from the bank, the same amount you should do. That way, you will cancel the contract. The difference in rate has to be settled by you. So what do we know? 2 months forward bid rate already contracted, 48.9. This is a selling rate for me. Today, if I take a 2 months forward contract, I should take the ask rate, opposite position. So I make a loss of 0.1. This is per US dollar. For the entire 4,50,000, how much is the amount? If I had already entered into a contract to sell, now I have to enter into a contract to buy. For sell, what is applicable is bid rate. For ask, what is applicable, for buying, what is applicable is ask rate. Always the bid and the ask is from the bank's point of view. So I end up losing 45,000. This amount has to be paid. So let us see what is the position. I am going to lag the receivables and cover the balance payable. So I will get export receivable in 3 months. This 450 can straight away be used to actually pay 7 lakhs. So the balance 2,50,000, if I enter into a contract, that is enough. So what will be the net payable? But when I cancel the contract, 45,000 has to be paid. So what is the net amount payable? Between the two, it is a payable. So between the two, whichever is less, that is what I will choose. Now, if I cover the payables alone in the forward market, my net amount is 121.79. If I lack the receivable and cover the balance payable, it is 123.32,500. It is a question of payment. It is a payable. Therefore, whichever is less, that is what I will choose. Okay, hope you have completed this. Now, currency futures will also work the same way. What do we know about currency futures? They are exchange traded. And currency options, which are exchange traded, it will act in a similar manner, except under currency option, you have the option. You don't have to necessarily exercise, whereas if it's a future, you're obligated, you have to exercise. So currency futures means what you will do. Again, you will see whether the foreign currency exposure is a payable or a receivable. You will consider the underlying base currency. What is the currency requirement in underlying currency units? See, the moment you go for an exchange traded product, you have to see what is the base they have. That cannot be changed. Then contract size will be there. We already saw exchange traded product, 4 things we saw. What is the base currency? What is the contract size? When is the expiration? How is the settlement made? So those things will be there. You will decide and buy or sell the futures contract as required. Then you will close the position and find the profit or loss. Yesterday also we did the margin account. Now, whether it is an option or it is a future, the margin amount, if they give and they ask you for the interest, that has to be considered. Because the option premium is paid upfront, and later on, when you actually take after 3 months, what is the position? Interest you have to compound and take. Similarly, in futures, the margin money which you have deposited, on that you should consider the interest and you should take. So, what is it we have done today? We have done chapter 10, Forex exposure and risk management. We discussed regarding exchange rates, the 2 ways in which you can quote, direct quote, indirect quote. First of all, what is an exchange rate? Then what is direct quote, indirect quote? American terms, European terms. And then did generally some 2-3 problems. Then we looked at what is a forward. Then we did few problems on forward. Then we discussed exchange rate theories, purchasing power parity theory and interest rate parity theory. While on this, we also discussed the exposures, which you have the 3 types of exposures and what effect it has. And we discussed foreign currency options, foreign currency forward contract, and all of that. So, are you comfortable with what we have done? Is it clear? Tomorrow, we will be handling international financial management. That chapter we will do.